Okay, so very good afternoon. Today we shall be discussing about how to make formation of your portfolio. That's very important. I shall be doing this portfolio building task in the context of Finnish companies. You can do in the context of any company, as long as the three, four, five, six companies that you pick up, as long as they are in the same stock exchange, it's perfectly fine, right? So the exchange, the country where these companies are listed, is not a big problem, okay? But what matters is that you need to make a commitment with me in your presentation, in your Word file, which you will be submitting. And even when you pick up the companies, and you let me know on discussion forum that these are the companies which we shall be analyzing, you have to make two commitments. The first commitment is that tell it very clearly. Are you a risk averse, risk lover, or risk neutral investor? I think we made some kind of categorization in the past lectures that if you are a really risk lover investor, then the obvious measure of risk loveness is the beta coefficient more than 1. I hope I discussed with you. So the beta, did we discuss beta? We did. The beta coefficient should be more than 1. And if you are a risk neutral investor, the beta can be 0.8 and above, but less than 1. And if you are a risk hater, we use the phrase risk averse investor. In that case, the beta should be less than 0.8. So we need to be careful about certain things, that how, to what extent we need to take our measure of riskiness. That's the first promise. You have to make a promise with me when you choose your companies in the discussion forum, and somebody should start discussion, that give the title selection of companies and nature of investor. So the first thing, you let me know which companies you will be analyzing, and number two, are you a risk lover, risk averse, and risk hater investor? And give the name of all the participants. So only one person, if you are you doing this task in a group, yeah? Are you doing in a group work, yeah? So in the group, I don't want to receive 5 different emails from all the 5 members. One group leader should write me that we are this group, and I'm so, and these are my group members. Write the names, okay? We choose to be the risk lover investors, and these are our companies, okay? The second promise you have to make is that are you a value-based investor or a growth-based investor? All right. So your choice should reflect if you are a value-based or growth-based investor. Number two, if you are a risk lover, risk hater, or risk neutral investor. I give you an example. Imagine you make a promise with me that you will be behaving like a risk lover investor. And when I see your companies, they are the retail companies or some housing company. Come on, they can never be risk loving. They are not risky companies. They have very stable cash flows. How come they are risky? But if you choose some IT company, some R&D company, some biotech company, some media company, that shows that you are a risk lover investor. And the second thing you have to show that are you a value-based investor or a growth-based investor? Can somebody tell me what are the benchmarks of value-based investors and the growth-based investor? Does anybody know what is value-based investor and the growth-based? You should know. Mm-hmm. 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 Very good, very good. The growth-based investor have this kind of philosophy that they are buying the stocks which are more expensive than the rest of the other stocks in the same industry, right? Because they are hopeful that this stock is selling higher. It will go even higher in the future. On the other hand, the value-based investor think opposite. He or she thinks that it's good to buy cheaper stock. Cheaper means the lower P to E ratio in comparison to the rest of the industry or sector. And then, and the reason is that the market is treating unfavorably to this company. But once these kind of anomalies, once these kind of discrimination would be over, then the price would go up. And when it goes up, sell it, make money, have capital gains by selling the stock expensive. So buy cheaper, sell expensive. That is the motto of the value-based investors. The growth-based investors' motto is buy expensive, sell even more expensive. So there is a philosophical difference between the two. So these kind of things, you have to make a commitment with me in your, when you are writing me the messages in the discussion forum. And you don't have to write, not every member has to write a message. And don't write the different messages under different titles. So maybe one title, somebody should start the discussion and the other should follow it. So let's keep it simple and clean. As I said before, that I would be discussing the portfolio formation in the context of the Finnish companies. And I'm choosing today, let's say I am a value-based, risk-neutral kind of investor, slightly towards risk-hater investor. And I'm going to choose 3 companies for myself. And these are 3 Finnish companies, 3 the most famous companies in Finland: Nokia, Finnair, and Kone. Nokia, you know, is an IT firm they make all this information technology products and services. Kone, it's a very typical engineering company making all the elevators. They're world famous, and that's Kone. And the Finnair is Finnair, you know very well. It's a national carrier. Okay, so but the stock exchange, the Finnish stock exchange. So one thing is clear now, that none of you would be choosing Finnair, Kone, and Nokia, because I'm doing it. Okay, so I want to be fair and square. So don't choose these 3 companies. If you want to analyze Finnish market, there are many companies you can choose from, no problem. Okay, but don't pick up. Now this is on the record. Okay, I'm recording it. So none of you would take Nokia, Kone, and Finnair. The stock market where these companies are trading is OMX, NASDAQ, NASDAQ Nordic. This is the stock exchange. Let me see if this is showing up. New share. Yes, this is showing up. Good. Shares, indexes, bonds, options, exchange traded funds, news about us, many things. First of all, let's pick up stocks. And the first company I pick up is Nokia. Okay. So what I do, Nokia is a company, so the company's shares are trading in the market. So the first thing I would do would be shares. And here, I look for Nokia. And you can see that Nokia is in euros and Nokia's in Swedish kroner as well. I would go for Nokia Euro because in Finland, because I want to take Finnish companies. So we take Nokia with euros. So I take this company because Nokia is trading in Sweden and in Finland. Yeah. So, but I take the Nokia which is trading in Finland. Okay. And here you can take some kind of market data about Nokia, that Nokia has almost 5 billion shares. You can see here. And the market value of Nokia is approximately 26.5 billion euros. So it's a huge company. Yeah. Now, what we need is we need the historical prices. Historical prices. Then I go to historical prices. And I have to type Nokia once again. Nokia Euro. And let's say I'm taking last 3 years data. 3 years data. Okay. Did I say you 3 years or 5 years? 2 years maybe. 3 years is fine. Yeah. It doesn't matter because it doesn't matter. It won't take you double time to get 4 years. All right. So it doesn't really matter. So let's say somebody should remember the date, the from date should be common. Till date is today, of course. Today is the latest time, yeah. But remember that we start trading from. Somebody remember that our starting date is 24th August 2015, because for all the companies the date should be common, yeah. Somebody write 24th August 2015, and our finishing date today is 24th of September 2018. Yeah. What date is today? 24th. Why not 20? Huh? Today's 25th. Yeah. Why not 25th showing yet? Because the market is still working. Okay. Let's search. And afterwards, you can download to CSV. Download to CSV. It's by default, right? And you can see that. Let me see if this spreadsheet is showing. Yes, it's showing. And here you can see that. First of all, I want to show you, if we have the data, if a cell is small, make it big, then it's fine. First of all, I need to check if we have the data right from the beginning. Yeah, we have 24th August. Yes, we have starting from 24th of August 2015. Yeah, and yeah. Are you all okay with this? Are you fine with this? You know, this spreadsheet will come. So first I take one company. So I want to save this data and I want to save it on desktop so that it's easy. Let me call it fin data. But one thing I would like to save it in XLS format, not CSV. I don't know. I don't like it. This is better. Okay, makes sense. Date, you know very well, the trading date. Can somebody tell me why 22nd and 23rd are missing? Why is there is no 22nd and 3rd? Sorry, they are the weekend, so there's no trading. Yeah, so obviously, bid rate. Bid rate is a rate at which the exchange buy from you. Let's say you have Nokia share, yeah, and you want to sell it. It means the exchange, the broker, the agent will buy from you. When he or she buys from you, he would pay you this much money. That's called bid rate. But if you want to buy, it means the exchange want to sell, then they would charge this money from you. The ask rate is always higher than the bid rate. Can somebody tell me why? Because the difference is the profit. If you are selling pencils and you are buying a pencil for €1 from a supplier, will you sell the pencil for €1 to the customer? The selling price is always higher than the buying price. That is why the ask price is always higher than the buying price. Bid means the buying price, but not you buying, market buying. And seller means not you selling, not you selling, market selling. So see, the bid and the ask price are always from the point of view of the market, the seller. So be careful. Opening price, when the market starts on 24th of September 2018, that is yesterday morning, the market was opening at this price. During the day, the price went as high as this. During the day, price went as low as this, but the market closed at this price. The average price, all the day price was this. Average price is nothing. It's non-existent. Okay. The price which I would rather take is the closing price. Do you get my point? Yes or no? You don't get this point? Why would take closing price? Why not average price? Because average sometimes is nonsensical. Nonsensical. Imagine there are three persons and they have the money in the wallet. One is having 100 euros. Second is having 200 euros. Third is having 700 euros. How much average money they have? 100, 200, 700. Sorry? 100, 200, 700. Sorry? 1,000, yeah? 1,000 divided by 3, 333 euros. 333 neither belongs to 100, nor 200, nor 700. Do you get my point? It's middle. It doesn't show any of them. That is why average sometimes could be inconclusive. And imagine even more extreme example. Somebody has 1 euro, other have 2 euro, and the other person have 1 million euro. Find the average. It belongs to none, basically. It makes no sense. So that is why the average could be misleading. But some people agree, say that, okay, average is fine, but average represents nothing. You have a question? Yeah. Huh? I'm yet to tell. I'm yet to tell. But at the moment, I'm discussing with you that which price matters to you, which price you aim at. Look, there are so many prices: opening, high, low, closing, average. Which price you will look at? You will look at the closing price. Make sense or not? There we go. It means that if we are only going to have look at the closing price, then why do we have all these columns? Delete them. Delete them. We don't need them. You can ask a question, yes. Not necessarily. It's not automatic. They don't leave something before they close the shop, that when they open the shop, it will be there. It's a price. It can be, see what, I tell you something. Let's say last Friday, the world was in normal. Everything was normal. Saturday and Sunday, in that country where the stock exchange is, there's a big political crisis. Do you think that on the Monday, the price will start from the same level where they left on Friday evening? No way, no way. Market would be crashed. So it's not necessarily, it looks that they should be common, but they are not always common. They may be common, but it's not mandatory. All right. The average price is, I don't like it. Let's delete it. Then comes total volume, turnover, trades. Total volume, turnover, and trades. Listen carefully, otherwise you'll miss out something. I'm not going to use total volume, turnover, and trades in the data analysis, but you need to know, as a student of finance, you should know that what's the difference between these three terms. Imagine, once again, I gave you a non-financial example. Let's say you are a furniture merchant. You sell furniture, yeah? You sell tables. You sell tables to the customers. On one day, you sell 5 tables. Write down somebody. You sell 5 tables. Or let's make it, you sell 50 tables. You sell 5050 tables. This is called the total volume. How many shares were traded? Yeah. So you sell 50 tables. That's volume. The price of one table is 100 euros. What is the value of tables? You sell 50 tables at the price of 100 euros. 5,000. That is the turnover. Now trades. Trades is very tricky. You sold how many tables? You sold how many tables? 50. Do you think that you have 50 customers? It could happen that on a given day, you sell 50 tables and there are 50 customers, each of them buy one table. But there could be possible that there are only 2 customers during the day and they buy all 50 tables. You get my point? The volume, the size of the trade could be different. You can buy 100 shares, you can buy 1 million shares on that day. That shows the number of trades. Sound sense? When you're a bank, not the individual or a financial institution, you can buy or sell shares in millions on a given day. But if you're an individual customer, individual investor, you may buy a few thousand shares. Depends upon your capacity. It could be possible that on a given day, there are 7 customers buying 50 tables. There are 10 customers buying 50 tables. Or there could be 1 customer taking all 50 tables and nobody else comes to your shop for the rest of the day. It's quite possible. That shows number of trades. Okay, but this is again customary. This is again for the sake of your academic knowledge. I will not use them for the data analysis. So what I'm going to do is, after explaining the meanings, I'm going to get rid of them. All right. This is closing price of which company? Nokia. So let's specify this is Nokia. Yeah, Nokia closing price. Now our first job is done. We have downloaded one company's data. Now the next company is Finnair. Yeah. So once again, let me save it. Once again, I go back to the website. Let me confirm you are seeing the right page. Yeah. Let's say Finnair. Finnair Euro. This date, what was the date? Was it 24th August 2015? So this is the right date? Yeah. All right. So search. After searching, download to CSV. So we have another spreadsheet. Yeah. Is it fine? You can see that 24th September 2018. Let's see if the number of days are same. If they're same, the last date should be very important. 25th August, 24th August. Yeah. Is it 24th? Did we start from 25th August or 24th August last time? Last time, Nokia. We can check it. 24th August. Very good, very good. So we are fine. Yeah. Once again, from this, this is Finnair. Yeah. Once again, I need nothing else from this company. The dates are same. I don't need bid, ask, average, opening. I don't need it. The only column I need is which? Closing price. So what I do here, I copy this cell. I go here and then I say, I paste it. Finnair closing price. Yeah, it's fine. Are you with me? You getting the idea? The third company, now we can delete this. We don't need this spreadsheet. We are done with this. Just leave it. We are very opportunistic people, yeah. And the next company is Kone. Go to the website, Kone Euro. This is the Kone. Once again, 24th of 2015 to 24th September 2018. Yeah, the starting date is fine. And then download to CSV. Not a bad idea to double check if the closing date is same, because otherwise we can have less number of rows, which could be, yeah, this is fine. And as before, we need nothing else from this spreadsheet. All we need is closing price of Kone, copy it, oops, and paste it here. That's closing price of Kone. Oops. Yeah, this is fine. Any problem now? Are you missing something from the data? Are you missing something? I wanted 3 companies. I have 3 companies' stock prices. Am I missing something? Yes, I am missing something. Please, somebody tell me what I'm missing. Market. How would I compare with the portfolio? I have to compare with the market. Come on. So I need market. Once again, go to the market. This time, because we are looking for the market index, yeah? Look at the word market index. I can't find index from stocks, from the shares. Then I go to index. These are indexes. Now, these are the big market indicators. OMX Nordic 40 is fine, but the problem with the OMX, I like OMX Nordic 40 a lot, but these are 40 top companies in the Nordic, which includes Finland, Norway, Sweden, Denmark, Iceland. But here I have only taken Finnish companies. If I take, for example, Nokia, Volvo, and some Danish company, then I can take Nordic 40, yeah? But here I'm only taking Finnish companies. And for the Finnish companies, there is sorry, it should be here. OMX Nordic large cap Danish kroner. And then comes OMX Nordic large cap euro. That is the only exclusively Finnish companies index. So GI, I take this as an index. Even though that's not a big deal, I tell you something. You can take OMX Nordic, not a problem at all. But I think it's better to take the Finnish companies, the Finnish index. Is any other index which I can take? No, they are the mid cap. So I need large, because these 3 companies are the largest companies in Finland. So mid cap, no. I rather take GI, the general index. So if I click this, and then I take the historical prices as before. And where do I make a choice? Yeah, yes, I can make a choice here. 24th September, 24th August 2015. So let's change it to 15. We only change year because that's what we are doing for the other companies also. Let's search and CSV. CSV. We have the closing index value, the closing price or the closing index value. Sorry, I think I haven't written closing price. This is Kone, yeah? The third one was Kone, so I should write Kone, closing price. So this is the index closing price, I guess. Let me double check. I don't want to make a mistake. 238 or 237 closing price. Yeah, that's fine. So I take this as an index value. I copy and I can paste here. 2, 3. And I can get rid of all other spreadsheets. I don't need them. I don't need them. Yeah, let's leave it. Now, please tell me, do we have got all the data? Can we do so this is the closing price. So let's call it the index value. Index, which means the market value. What should we do now? Can we start analysis straight away? What do we need to do the next step? Anybody knows? Return. They are prices. They are the prices. We need to calculate return. I told you, do you remember that the stock performance is not dependent on the price of the stock. It depends upon the return. And how do we calculate return? Return is the current price minus previous price divided by the previous price, but don't forget brackets. Because if you don't put the brackets, it could be catastrophic. So now we calculate the return of each company, yeah? Do you have any questions so far? Are you fine? So let's find Nokia return, Finnair return, Kone return, and then the market return, let's call it index return. Index return. Okay. Now, see, first of all, I'm going to do the Nokia return. It's very important that you pay attention to it. Bracket starts. First of all, start with is equal to bracket the current price minus the previous price, bracket closes, divide by the previous price, return comes for 1 day. And if you don't have to drag it. If you find this, look at the sign. Look at how it changes the sign, the cursor. Look, you have a plus. Yeah, have it. If you have it, click it in the corner. It will calculate all the way down. So you don't have to. So that's why I said that it doesn't matter you take 2 years or 20 years. It the same way. So this is Nokia return for last 3 years. The same way, we calculate Finnair return is equal to bracket starts Finnair current price minus Finnair previous price, bracket closes, divide by previous price is equal to, go to this cell, plus sign, click it, goes all the way down. And then the same thing you do for Kone. Kone is here, minus this. And then the same thing you do for the index return, yeah? Index value, this, minus this, divide by this. There we go. Are we missing out something now? Are we missing out something? We are missing out, actually. What we're missing out is that you are going to form a portfolio. Remember, your portfolio is comprising of 3 companies. You have to club 3 companies into one. You have to make a bundle package of 3 companies together. Because even though you're trading in 3 different companies, but you make a one portfolio. The portfolio is comprising of 3 companies. You never invest in one company, do you? Unless you are extremely risk-lover investor. I suggest you never do it. You always make a portfolio. And one more thing, in the beginning of this exercise, I told you that before I pick up these companies, it seems that I'm a value-based, risk-averse, or slightly risk-neutral investor. But in reality, if you are a value-based investor and risk-neutral or risk-hater, especially risk-hater, risk-averse investor, there is a flaw in the choice of my companies. And the flaw is that if you want to be a risk-averse investor, 3 companies are very risky, yeah? Have more companies. So if you choose to be a risk-lover investor, choose less number of companies, 2, 3, 4 max. But if you want to become a risk-hater investor, risk-averse investor, you want to avoid risk, then have large number of companies. So I'm only taking 3 stocks. So imagine if I'm doing this assignment and you are my teacher, the first mistake you will find, you will say, hey, Shab, what is this? You claim to be risk-averse investor? Come on, you sound risk-lover investor because you took only 3 companies. 3 are too less because you are claiming to be a risk-hater. In that case, you should have at least 7, 8, 9, 10 companies. Okay, you get my point? So, but this is only a task. This is only an exercise. That's why I pick 3 companies. Moreover, if I pick more companies, then you will not be allowed to take those companies in your assignment. So I'm leaving some more options for you. Okay. I think up to this, things should be clear. Let's say, now what I'm going to do here is a little bit different, awkward, but it's important. I'm going to add 3 rows here. 3 rows. Nokia, Finnair, Kone. I have 1 million euros with me. I have 1 million euros with me. I'm super rich. But only in my imagination. So 1, 2, 3, 4, 5, 6. Let's say I invest 3 million. Oh no, 300,000. 300,000 in Nokia. 500,000 in Finnair. Kone, 200,000. But be careful. I'm doing only an exercise, so I can pick up whatever proportion I take, but you have to justify, in your report, you have to justify why did you pick up these companies, and secondly, why did you put this much money in each company? So you have to give a justification to me. You get my point? You have to justify everything you do. It means that in percentage terms, this is 1. This is 0.3, 30%, 50%, 20%. These are the portfolio weights. Well, I can create one more column here. That will be even better. So you have total wealth and portfolio weights and companies. You all right with this? So you have 30% in Nokia, 50% in Finnair, and 20% in Kone. Any questions so far? All right. Well, you can choose the number as you want, but you have to give me justification. In the presentation, I can ask you, why did you pick up this company and why did you invest this much money in this company? You should have a reasoning for this. Give me some reason. Some reason. Well, that's you write in the report. But my point is that find a reason. That's more important. Which reason? That's a different thing. Okay, and I can verify your reasons when you put the references at the back of the report, because you will be writing the references also. Yeah, something. I mean, if you pick up value-based companies, then show me that these are the value-based companies. That's why you pick up. And this company is more value-based, hence I put more money into it. This company is slightly borderline between value-based and growth-based, so I put less percentage to it. So find some reasons. Okay, that's why read some books, read some articles, literature. There are tons and tons of articles available in the Optima. Okay, even today I put very important article, investment strategies. Go for it. Now, very important. Now I'm going to merge 3 companies into one and call it portfolio. Do you get my point? Because you have created a portfolio of 3 companies. A portfolio itself is like a standalone stock, but as a combination of different companies' stocks. The portfolio is basically your weighted average. Weighted average. Now here, steps are very important. So I suggest to you that don't discuss anything until I complete this step. So here I call portfolio return. Which company is my first in the list? How much? Which company is my first company? Nokia is equal to, bracket starts, Nokia's return. Nokia's return is here. But am I only investing in Nokia? What percentage I invest in Nokia? Sorry? Which cell is this? 30%? Which cell? C? C3. Multiply by what? C3. But this C3, if I write like this, will make wrong calculations. You know why? Because this 30% would remain constant. If you want to keep something constant in the Excel, you put $sign between the number and the letter. So what do I do here? Put the $sign here. Bracket closes. If you want to keep some value fixed, then you put the $sign. Yes. For the fixed value, because you will keep fixed 30%. And then you plus, which is your next company? Finnair. Finnair return here. How much money do you invest in Finnair? What proportion? 50%. 50%. Once again, put $sign between D and 3. Bracket closes. It's nice to put the brackets, because bracket, if you don't put the right brackets, it could be real trouble. Plus, which is third company? Kone. How much return? How much proportion in Kone? 20%. But put $sign. Use the brackets. They always save you. And afterwards is equal to. So on 24th of September, you had you lost money in Nokia, you lost money in Finnair, you also lost money in Kone, and on an average, weighted average, you lost this much money in portfolio return. Okay, and once you click here, the plus thing, once again, you can have portfolio return all the way down. Yeah, make sense? Okay, now tell me one thing. The next thing you want to calculate is risk? Or should let's calculate risk first. Risk is of two types: systematic risk, unsystematic risk. First of all, I'm going to calculate systematic risk. To calculate systematic risk, the best measure of systematic risk is beta. Beta is a measure of systematic risk. Beta, if you remember in the last week's lecture, beta is the slope. Slope, you remember? Slope, or what is the other name I used? Which normally in the English textbooks is a substitute of slope. Gradient. Slope or gradient we use. Now what I use here, slope is the change in the stock return, the portfolio return, divided by change in the index return. Are you clear about the dynamics of slope now? Are you fine? Okay, now what we do here, since beta is the slope, right? So if you type in slope, you will be getting slope here. Do you get it? Slope. Which data will you select first? Portfolio return or the market return? Portfolio return. So where is portfolio return? Choose here. Your portfolio return should be, normally there are 250 working days in a year. So yeah, so well, some numbers are missing, so we can delete that data. This much is okay. So the last, remember somebody, our last value should be 783. Yeah, and then we go up, semicolon, J5 to J783. There we go. This is beta. And you can see here, beta is 0.05, very, very low beta. So my portfolio is very less exposed to systematic risk. Yes. Yeah. Why I put portfolio return? Look at the formula of beta. Beta is delta Y divided by delta X. What is delta Y? Delta Y is the stock return or portfolio return that comes first. Divide by, I can't divide like this here because I have multiple data. So I take semicolon. And then I select the X. X means the index return. That comes at the bottom. So first pick up the company stock return or the portfolio return. All right. And then you basically divide by the index return. And that would give you beta here, slope, known y's, known x's. Okay. So in this case, beta is very, very low. I'm really, my teacher should be very happy because I chose to become risk averse, value-based investor. And my risk is my market risk is close to zero. I mean, which portfolio would give me a risk which is almost zero market risk? You get my point or not? You get it? Very good. The next thing we need to do is the unsystematic risk. Unsystematic risk. Does somebody knows what is the measure of unsystematic risk? Does somebody knows what is the standard deviation of what? Portfolio. Unsystematic risk, I'm putting a note here. Unsystematic risk is standard deviation of the portfolio. If you're taking a portfolio, if you're taking only one company, then stock, then one stock is you can have one stock portfolio also. So this is, in this case, we have 3 stocks portfolio. So standard deviation of the portfolio measures unsystematic risk. All right. And where is the portfolio return? Well, the portfolio return is here. This is the portfolio return. Right? And we went to 783, yeah? 783 is the last. So we need to go to K783. K783. Now look at the formula. Standard, can you see standard deviation here? The last but second. Can you see here standard deviation? This is standard deviation. So click this. Your first number is K5. And I hope you know that your last number is K783. We have 783. So K783. This is the standard unsystematic risk. Unsystematic risk. Yeah. Just with the port. Look at the formula. That will help you how I get it. So that is why I choose XLX, because you can highlight the formula. I think in CSV, I find it always hard to highlight the formula. But that's your choice. That's not. So that's the unsystematic risk. But there's a problem. There is a problem now. The problem is that even though we have 3-year period, now listen to me carefully. Even though, any question? Amaya, you have any question to ask? Nadia, you have anything to ask? Okay. There is a technical issue here. The technical issue is, even though this unsystematic risk, which is standard deviation, is calculated for 3 years data, but this still shows the average daily standard deviation, because your stock return is daily stock return. Are you getting the point? This is the average daily standard deviation. Generally, we like to show the data, present the data annually. Annually. Yes or no? Yes or no? Unsystematic risk. Unsystematic risk is your average, is the standard deviation of the average daily return. All right? But it's good to show the data in the annualized form. Annualized. So what I'm going to do is, this is the unsystematic risk, of course, but this unsystematic risk is of daily standard deviation. I want to annualized unsystematic risk. Annualized unsystematic risk. There's a way, there's a formula. Annualize it. How many working days you have in a year? Generally speaking, there are 250 working days. Working days. 365 days, 104 weekends, which means 2. Then there are some vacations and stuff. So I think 250 is a good benchmark of working days. because the market is closed at least for 104 days in a year, then it's not a good idea to use 365 as an annual measure. I would rather take 250 as a compromised working year. In different companies, in different departments, we have different working days, but 250 is somewhat standardized working, days. So what I do here, how I annualize it, look very carefully. The daily standard deviation at this M5, square root, square root? This is square root. Square root of 250, bracket closed. It means that if there is a 0.01 deviation in a daily basis, then on the annual basis, it becomes 0.25. So what I do here is, I simply multiplied the daily standard deviation with the square root of number of working days. And in this example, I assume that working days are 250. Different books use different, in some books, they even use 365. They say, we don't care about holidays, 365, 365. So different books, different authors have different opinion about it. But I think 250 is a compromise, is an average, is a kind of consensus kind of number. Square root is important. Square root. You know what is square root? What is the square root of? What is the square of 2? What is the square of 2? Sorry? 4. What is the square of 3? 9. When you multiply the number by itself, 5 square, 25. If 5 square is 25, then the square root of 25 would be 5. Square root is the opposite of square. Are you with me? Square root is the opposite of square. If 5 square is 25, then 25 square root would be 5. So you take the 250 square root. Because you can't write square root formula symbol in the Excel, so we type in SQRT, square root. And this gives us 0.25. I would say that in the market, for the 3 years data period, the annual risk is 25.36% to your portfolio. Your portfolio is facing 25.36 risk on yearly basis. Are you with me? Remember, we had the daily return, daily risk. From daily risk, we made the annual risk. Okay? Then we find out total systematic risk. Total systematic risk has a formula. And the formula is total systematic risk is, sorry? No. Total systematic risk is beta multiplied by standard deviation of market. Okay? So beta multiplied by standard deviation of the market. And where is market? This is market index. So what we do here, beta multiply standard deviation of market, and the market starts from which number? J5. And how far you go? Well, you go to J783. Have you forgotten? This is the total systematic risk. But there's a problem here. This is also what? Daily. So this is the total systematic risk. But see what? This is total systematic risk of what? Daily basis. Just the way you annualized unsystematic risk. Remember, your unsystematic risk was daily basis and you annualized it. The same way you would be annualizing your systematic risk also. Okay? You will be annualizing your systematic risk, but be careful that don't square the beta. Beta will not be squared. Beta will not be squared. I'll tell you a reason why beta will not be squared. When you are converting your daily systematic risk to the annualized systematic risk, make sure that you are not doing anything with beta. Leave the beta as it is. All right. So what we do here, annualized systematic risk. Look, your market standard deviation can differ when you take the daily stock price data, but the beta will remain constant. Your beta is constant. Standard deviation in this, are you taking daily price data or annual price data in this case, in this question? Daily. You have to answer all of you. Is it daily stock return data or annual? Daily. Therefore, any standard deviation you calculate would be daily. We have to annualize it the way we did here. I'm coming on that point, but you don't have to annualize beta. You don't have to annualize beta. The line could be this much or line could be that big. Slope remains same. It means if 1 day, 1 month, 3 months, 1 year, slope, if it is straight line, slope remains same. Do I have some scale or something? If you have a scale, the slope is same. You have half scale, break it into 3 parts, slope remains same. Break it into 20 parts, slope remains same. Therefore, don't do anything with the beta. Beta is beta, final. But if you want to analyze standard deviation, then you have to change something. Then you have to multiply square root of 250. That's you have to do. Okay? Make sense? So now what we do here, to get annualized stock return, to get the annualized systematic risk, we use beta times standard deviation from J5 to J7, 83 times square root of 250. That would give you the annualized systematic risk. This gives you the annualized systematic risk. Annualized systematic risk. Wait a sec. We need to be careful that This is not unsystematic risk. This, when we use the standard deviation, we calculate the total risk. Total risk. So therefore, we need to make a change in our comment that standard deviation of the portfolio measures total risk, not unsystematic. This was a big mistake. Okay, so this is annualized total risk, not unsystematic risk. Let's be clear. This is a total risk. The total risk which your portfolio is exposed to is 25.36%. Whereas the annualized systematic risk is very, very less, close to zero. And now you can find out total unsystematic which is, how would you find unsystematic risk? When you have total risk minus systematic risk. You have total annualized risk minus you have the annualized systematic risk. That would give you the total market risk. But coming back to your point, I think you wanted to get the formula, yeah? The formula is here. So you have L5. L5 is beta multiplied by standard deviation of the index or the market. Yeah? L5 is beta multiplied by standard deviation of the index values. All right? And then we multiply by square root of 250 because the standard deviation that we have is daily. We want standard deviation for the full year. So that is why we time it by 250. 250 square root. So we have three things multiplied. Total systematic risk is beta times standard deviation, but that standard deviation is daily. And then by multiplying square root of 250, we can make it annualized. That's the idea. And now, basically, you have all the risks calculated. Your portfolio is having total risk this much. Unsystematic risk is nearly 99%. And the systematic risk is close to zero. So most of your risk to this portfolio is coming from within the companies, within the choice of selection of the companies, rather than the market. Market is not affecting it. It's close to zero, very close to zero. This one? This one? This one? Well, it's the difference between total risk and market risk. So total risk is this, systematic risk is this, and this is the difference. This is the difference. All right. Okay, good. Are we missing out something now? We have total risk. We have total risk. We have systematic risk. We have unsystematic risk. What is the opposite of risk? Return. We are missing return. We are only calculating how much risk we are facing. But what about earnings? What about what we get? Return is quite simple. The formula of daily portfolio return is, your portfolio return is this much, yeah? Well, you earn it for 783 days, yeah? So if you have return first day on, let's say, if you have return first day, 2%, return second day, 3%, return third day, 4%. What is the portfolio return then? How do you find the average portfolio return? Well, you add 2% plus 3% plus 4%, divide by 3. Same thing, you have the 783 days daily return, okay? Find the average. Did you get the idea or not? Remember, what is your, by the way, what is your K column? Can somebody tell me what is K column? What is K? What is this K showing? But this portfolio return is for 783 days. Are you not interested in one average? Are you not interested in? But remember that return would be daily return, average daily portfolio return. From that, we can annualize it afterwards. But first of all, calculate average daily portfolio return. Let's call it daily portfolio. Let's call it average also. You know what I mean. Average portfolio return. Your column is K5 to K783. Very simple. Is equal to average K2 to K783. There we go. Oh, I'm sorry. It should be K5 because you start from K5. Apologies. Because the first number starts from K5, yeah? K5 and the last number is 783. You have 783 rows. K average daily portfolio return. But there's a problem with this. Can somebody make out? This is daily. You need to annualize it. Like anything else in life, you have to annualize the daily return also. And the formula, resume it. Now we have the annual or annualized portfolio return. And this would be, please tell me the formula, is equal to, the bracket starts first, the daily stock return plus 1, bracket closes, to the power of 250. Can you see this sign? This sign is for the to the power of. This arrowhead. This arrowhead is the sign of to the power of minus 1. It means that for the yearly basis, you're earning 25%. You are earning 25% return on your portfolio. This is a very handsome, very decent rate of growth. Look at your portfolio. I mean, this is a discovery by, say, accidental discovery. Your market risk is nearly zero. Your market risk is nearly zero. Your portfolio in the current times, when the markets are very sluggish, is 25%. Isn't impressive? It is. But look at your unsystematic risk. It's very high. That is something worrying. That the companies are giving very decent return, but the internal issues about the companies could be a big problem. Market is fine. There's no macroeconomic risk, really. Almost zero risk. Systematic risk is inflation, unemployment, deficit, some kind of interest rates can go up, exchange rates can go down. No. All those risks are nearly zero. And at the same time, your annual portfolio return is more than 25%. Where on earth in the modern times you earn 25% legally? Isn't it? So this is a very decent portfolio with 3 companies. So that's all you require to do so far to build up your portfolio. All right. Now, what have you done? Somebody recall. What have you done today? You have calculated return. Number two, risk. Number three, systematic risk. Number four, unsystematic risk. So you have return, risk, and then risk become further split into systematic and unsystematic risk. Now, what was your task? The task was you have 2 days. Let's say I don't remember those dates, but I think I wrote very clearly in the instructions. But let's say that 1st of October is the deadline. On 1st of October 2018, listen carefully, on 1st of October 2018, you build up your portfolio. After giving me justification, this is what I take and why, this is what I take and this is why I take. And this much I invest, and this is the reason why I invest this much. You make a portfolio, you take a percentage, 20%, 15%, 20%, whatever percent, you make a portfolio. On 1st of October 2018, you make a portfolio. And since when you start taking the stock prices? At least 3 years before. It means you also start from 2015, 15, 16, and likewise. Then on 1st of October 2018, you are making 4 calculations. Total return, total risk, then divide the risk, total systematic risk, total unsystematic risk. Your portfolio is created on 1st of October 2018. Then what happens? Let's say your course start is finishing on in December, yeah? Then you carry on. Let's say you continue you see your portfolio performance till 1st of December. Then on 1st of December, there'll be more days added. You don't have to recalculate everything. You will be simply copying and pasting additional days on top of these dates. So you create more rows, right? And put the additional data into that. You get my point? Now we have a starting point from 24th of September. Now, on 2nd or 1st of December, depending upon whether you do on 2nd or 1st, your starting point would be 1st of December 2018. And then all the data will go on like this, no change. So there'll be more data. Now you have 783 observation, yeah? 783. On 1st of December, I'm sure you'll be having at least 40 to 50 more observations. So you will be having around 820, 830 observations. Recalculate what? Recalculate total return, recalculate total risk, recalculate total systematic risk, recalculate total unsystematic risk. So basically, on 1st of December 2018, you will be having this kind of thing. Now, watch what I'm going to do here. Yes. But I'll come to that. First of all, let me explain what I want to explain, yeah? Table. So let's call it, your first date was 1st of October. So 1st October 2018. And then the closing date was 1st of December 2018. Return. here, return here. Total risk here, total risk here, total systematic risk here, total systematic risk here. Total unsystematic risk here, total unsystematic risk here. Jensen's alpha, we haven't done yet. I would do it one day. In the same spreadsheet, I would be saving and uploading this spreadsheet in Optima so that you can see it. Jensen's alpha on 1st October, on 1st December. And then here, you'll be making an additional column. And here you'll see change. How much your returns have changed. How much return? Your return was 2%. Your return was 2% on 1st of October. Your return was 3% on 1st of December. 3% minus 2% divided by 2%. 50% increase. How much your total risk have changed? How much your systematic risk have changed? I'm just using symbols, so don't get confused. How much your unsystematic risk has changed? And how much your Jensen's alpha has changed? I'll explain Jensen alpha when we meet next time. This is all you are required to do, okay? So what I'm gonna do is, I think I should save this copy. So I should only put everything in one spreadsheet. So this is what we need to do. I can save it here, maybe paste it here. Okay. Yeah. That's all you're required to do for your task. This is when you know these kind of calculations, you basically, your doors to the quantitative finance are opened. You know, after doing these kind of exercises, you are quite eligible to become some investment trainee in some hedge fund or in a bank, because you know that how to do the risk and return thing. So basically, it's not teaching; it's about training. It's a very practical, very applied thing. We are using finance theories, but we are using the real data to prove or disprove our theories at every step. Nothing is abstract, nothing is theoretical, nothing is philosophical. Everything is very clear and very, we have evidence for everything. Yes? Well, that's only a recommendation. If you do it on 2nd December or 3rd December, that will not be the end of the world. You can change the dates minor, but that's an idea, not the, huh? Sorry? No, it's not a deadline. But for example, if you be careful that you have good, decent gap between two periods. Let's say I don't ask you and you build up your first portfolio, your first date of portfolio formation is 1st of November. And then on 15th of November, you close your second date. That's not enough time. There should be at least 2 months between the. So if you build up this portfolio on 1st of December, then we have October full month, November, and you can make it, you can close your trading on, you can have this date, for example, let's say 25th of November is fine. So anything between a month and a half and 2 months is enough. 2 months, I mean, longer is better, of course, yeah. So I don't think you can make 1st of October. We still have a lot of time, isn't it? Today is only 26th, 5th. So you still have one full week to make a portfolio, right? So even if you make not on 1st or 2nd or 3rd, it doesn't matter. It doesn't matter. But the point is that have good, decent, a month and a half minimum between the two dates. Okay. So this is a task which you are supposed to do. This is the mother or the father of all the financial management calculations. We have more calculations to follow, but this is the most. If it goes in your head, this thing, then everything is fine. Everything is fine then. So what I'm going to do is, I'm going to save it, and I'm going to upload in your financial management Optima portfolio in the spreadsheets subfolder. But I have to change the name. I would call it, should I call it portfolio management? Portfolio management sounds good. Good name, yeah. So the name of this file was